Well, the global macro is shaping quickly, and we have companies within the auto space which have been laggards maybe for the last couple of years facing that global headwind. But that could well be changing. Are we at the cusp of a turnaround in FY26? But also one needs to keep in mind that it's a fast evolving environment because there are tariffs involved as well. Welcome to KYC. I'm Hersh Sayta, with me is Puneet Javeri, and today we're going to be talking about Uniparts Limited. Why? I have spoken a bit about the company already, but let's take it up and let's try and understand as to what exactly is it that I want to know about a Uniparts Limited. First is sustainability of growth. It's a weak demand environment. Can growth come back, in fact? And when you look at the last 3 years data, you'll know exactly what I'm talking about. So stay with us, and when we speak about the income statement, you'll know what I'm saying. So that's point number one. Point number two, tariffs, of course. It's a fast evolving environment globally. Maybe for the next 3 years, there will be uncertainty, and therefore, what's the company doing to stay, to insulate itself to a large extent from this uncertainty is what I'd want to know. And how is the tariff going to impact both margins as well as competitiveness, because the global supply chain is also changing, right, Puneet, where auto is concerned, and therefore relevant. The third one is persistency of weak margins. The margins have weakened substantially. They are now in the mid-teens. They've guided that margins will likely recover. How quickly do they recover, and how much will really be my question. Role and visibility of new business and award wins. Wanting to understand how quickly does that impact the P&L, how quickly does that translate to profitability. Execution of strategic initiatives, they have taken a few, and we'll speak about those as well. And thereafter, we'll speak about customer concentration. There is one large customer, there is concentration. Is that a risk at all? Or is there a way in which they are hedging that risk, or there is comfort that that risk will likely not materialize? So a lot of this and more we'll talk about this 1800 crore market cap company, which is Uniparts Limited. Let me start off by introducing what the company does. And it's basically an Indian-based manufacturer of auto components, but it does so for the world. It doesn't, in fact, it derives maybe less than 20% of its top line from India, and has always done so. It's not like it's seen a major shift in terms of where it sells to. A large part of its geographic concentration is US, and a large part of the other probably pie of revenue comes from Europe. So India is a relatively smaller pie. It specializes in engineered systems and solutions. So it's more niche in terms of its business as well as its product. And we'll talk a little bit about that. Maybe Puneet can explain that better than I do. But leading supplier for off-highway market, it supplies tractor parts to boost farm mechanization and productivity. And therefore, a lot of this is actually pushed to the West. And hence, it's actually a manufacturer for the West. It manufactures core components for construction and agriculture. Products are exported to over 25 countries worldwide, with nearly a 70% concentration to US and Europe. They have 125 plus customers, including the likes of a Caterpillar and a Bobcat. So some of the largest names within both construction as well as agri are the clients of Uniparts. Let's talk about the three product ranges, or the three broad categories of products that it sells. It sells to agri, it sells to construction and forestry, and it sells for the aftermarket. The aftermarket is essentially the second-hand market. So just trying to put it out there, that's aftermarket. Let's talk about capabilities: forging, machining, welding, heat treatment, surface finish, logistics, quality and testing, design and validation. These are just the broad level of products that it does. These are the categories under which it does all of the products that it does. So just giving that understanding. Now, in terms of the products itself, the first product is a 3PL, which is a 3-point linkage. What's a 3-point linkage? It's like the arms on the back of a tractor. Arms are attached, and thereafter equipment is attached on the back of a tractor. You can see maybe some pictures as well to kind of help explain exactly what it is. it helps in towing, it helps in sewing. So you have all of those functions which a 3PL will likely enable farmers to do. I hope I've explained it the best I can. Now, precision machine parts, that's the other, that's the second, major product category that it does. This is specially made metal parts that fit together perfectly to enable some of the commercial as well as forestry as well as agri-based commercial vehicles to do their job, right? So you have two or more parts which kind of get together like joints of big machines for things like construction, forestry, mining, and you need this all the time when it comes to such specializations and such industries. So all of those is what Uniparts manufactures. Then some of the smaller areas like fabrication and the like, where it's about cutting parts, joining metal parts, structural parts, or other components for both agri. And this is actually a very small part of the revenue, so I won't get too much into the fabrication angle. Can we quickly pull up fabrication? So I won't get too much into fabrication, but yes, fabrication is the other piece that they do, and it's also a little bit of customization that they do here. Now let's talk about construction and forestry as a market, as a segment, because that is one place where Uniparts does sell product. So it supplies precision machine parts here, hydraulic cylinder solutions, focuses on mobile equipment, especially in the construction market. It manufactures both North America as well as India. So some of these products are manufactured at both places. It's supported by 3 warehousing hubs in the US and Europe. It's entered the hydraulic space in 2007, I beg your pardon, and has manufacturing expertise as well as capacity in India. Then, of course, there's the aftermarket, which we've spoken about a little bit, but let me talk a little bit about that. It offers customized packaging, labeling. It supplies tractor parts to top US as well as EU aftermarket distributors, which helps them with regard to the aftermarket. And mind you, the aftermarket margins are also better, right, Puneet? If I've understood it right.
Yeah, right.
But the aftermarket margins too are better. Now let's talk about who do they serve. They serve global off-highway equipment makers, the likes of a Deere, a Bobcat, a Taffy, a Yanmar. All of these are major companies which sell the kind of products for which we've already described. In terms of its manufacturing, has manufacturing facilities in Ludhiana, Visakhapatnam and Noida. It has manufacturing and distribution units abroad as well. Eldridge, Iowa, Augusta, Georgia and Hennef in Germany are some of the hubs that they have. Let's talk about subsidiaries very quickly. Those are all the subsidiaries they have and all the countries that they have subsidiaries in as well. Most importantly, I want to now take you to the revenue mix, because that will help you understand as to why we focused on the first two products more than the others. Just look at the concentration here. It's about 96+% is only 3PL and PMP. So those are the two segments, and I'll just quickly give you the full forms for 3PL and PMP as well. Precision machine parts is PMP. We spoke about that, and 3PL is the arms of the tractor, which we spoke about. So 96% of the revenue just from those two products. So those are the key components. Now let me talk about industry wise as well, and here too the maximum concentration is agri, 62%. Construction, forestry and mining is around 37%. So when you're looking at a possible slowdown in any of these segments, you're seeing a slowdown even for this company, and which is exactly what has been pushing down the numbers for the company. Let's go straight to the key metrics now. We'll start off with the income statement, the balance sheet, the cash flows, the return ratios. We'll talk about street coverage, street cred actually, not street coverage, street cred, shareholding. We'll look at outlook and take the guidance that the management has already given, and we'll also take valuations. And at the end of all of that, we'll give you a KYC rating as well. So Puneet, should we start with the income statement?
Well, definitely. It's the company listed back in 2022. So since then, actually, the share price performance hasn't been very good. And that the key reason for that is reflective on your screen. We've seen the revenue fall from roughly about the 1200 to 1300 mark and go down all the way to 964 crores. That's one of the key disappointments about the performance, and the company has mentioned that it was in a down cycle between 2023 to 2025, and so it's more like a market-led down cycle, and that's what impacts auto companies, in the off cycle, if I can say the way. And Uniparts was because of that impacted. We also saw in terms of EBITDA and EBITDA margins, hence those have also eroded from the highs of somewhere around over 20%. It's come down now in the mid-teens, as Harsh highlighted, and that's one of the other key negatives on EBITDA. And you can see that margin performance from a high of about 22 to 24%, it's down now to 15%, and the revival might take at least for the margins to go back to those levels. That will be one of the key aspects that we'll question the management on. In terms of profits, again, the 3-year CAGR performance is down 20%, and that's subsequent to the fall in revenue that we've seen. So we've given this a thumbs down naturally because of the performance of the company in the down cycle, and hence in terms of income statement, we see that it needs the macro environment to give that kind of positive pivot, Harsh, for it to come back to growth.
Yeah, absolutely. And other companies would have faced pressure had balance sheet been weak, but this one isn't weak. And let's pull up the balance sheet and give you that perspective. Equity plus other equity is fairly healthy, which is nearly 900 crore. So basically book value is around nearly 900 crore, and 1800 crore is the market cap. You look at the borrowing number, it's 84 crore. But if I were to just give you perspective on that borrowing number as well, the long-term borrowing as well as the short-term borrowing is just about 84 crore. And of course, lease liabilities is something we have excluded from this number. So not a large borrowing quantum for an 1800 crore market cap, and nearly 900 crore in terms of book value. So that is the understanding with regard to borrowing. In terms of cash, it continues to have about 30 to 40 crore rupees of cash. It does an annual capex of around 30 to 40 crore. That's the guidance, and therefore it has decent amount of cash. In fact, it has 1 year of capex cash on its balance sheet. But what I want to understand is, what are they doing in terms of cash flow, Puneet? How are they going to utilize that cash flow will be the other question which I'll want to ask management as well.
Well, because of the company's underperformance in terms of revenue growth, we have seen that impact come in on the cash flow as well. So in terms of operation cash flow, it's gone down from roughly about 250 odd crores. It's down to 182 crores in the last year of FY25, while compared to EBITDA, the CFO to EBITDA has gone up to 125%. The net cash flow does remain subdued at around 14 crores. Compared to last year, it is a significant improvement, because last year the company reported negative cash flow. So a 14 crore impact hence is positive, and but still lower than the FY23 levels, where it was around 24 crores. So hence while we've given this a positive, that's largely because of CFO to EBITDA level. The net cash flow is something to watch out for going forward as well.
Well, yes, but CFO to EBITDA continues to remain healthy, as you correctly mentioned. Let's look at return ratios, therefore. Now, in terms of the way return ratios have evolved, 30% plus in terms of return ratios, which this one would clock, but it's come off sharply. Margin pressure, you also have some amount of pressure coming in due to demand, and you have your operational efficiency reversing, due to which you are seeing what you are seeing on your screen. How quickly can this reverse back, and can it go back above 30 will be the big question, but this is clearly a thumbs down. We'll have to wait and watch as to whether they can do that. Shareholding, Puneet.
Now, within shareholding, what's interesting is, Harsh, that over the last 3 years, we've seen the promoter holding largely remain stable, and that's a positive. But the shareholding actually could be a neutral as well, because we've seen a consistent selling from foreign investors as well as domestic institutional investors. And for foreign investors, the stake is down almost 60%. So roughly from 6.6% is down to 2.2%. So it's only 1/3 that they've still kept, and that's largely because of the underperformance in the company's financial that we've seen. The domestic investors as well, which includes mutual funds amongst others, have actually also sold out. They still hold 6% stake, and that subsequently has been bought in by the retail investors, and we've seen roughly a 10% addition over the last 2 years. But the stock, from an IPO price of 577, it's down to almost 400 now. So over the last 3 years, we've seen that kind of underperformance come in, and hence, we've seen the FIs and the DIs sell out at this particular point of time.
Okay, so that's with regard to street cred as well. So street cred not looking too impressive. Now let me look at what the outlook seems to suggest with regard to this one. And can we pull that one up? So one, they've guided for a mid-teens growth in terms of top line. New business awarded should drive revenue growth going forward. How quickly does that translate? Moderate recovery in existing business is expected, but nothing substantial. Expect pickup in H2 of FY26 is what management has said. They're expecting margins from the lows of around 16% to bounce back a little bit for sure. They're seeing medium-term margin recovery to over 20%. If that were to happen, that lever will really work wonders with regard to the numbers. When I was running it, that's what I realized. And expect ROCE to improve in the medium term. How much can it improve? How quickly can some of these numbers improve will determine the turning of this business. But valuations, how are they looking, Puneet?
Well, based on the company's earnings as of now, it trades at 20 times price to earnings. But this has to be taken with a pinch of salt. While it might look attractive compared to the other auto component players, because we've seen re-rating on multiple auto component makers, the earnings actually has been missing from Uniparts. So we've seen for price to earnings, we've actually seen a fall in prices, and hence that multiple has reduced a bit. But in terms of price to earnings, hence we could see some more, some more clarity actually from the management in the subsequent quarters, because they have highlighted that from Q3 onwards, that bottoming out has finally finished, and we could see some growth revival over this particular point of time, and that has started in Q4. But this will have to be taken on with a little bit more context of growth where it comes, and if so, from which regions, because we have seen geopolitical tensions amongst others, 85% of the company's revenue coming from global markets. So that has to be taken with a lot of caveats, and we'll be of course speaking to the management today to get to a little more perspective to arrive at the right valuation number as well.
Okay, that being said, let's quickly summarize this and look at some of the parameters, and quickly let's have the other, perfect, let's have the final rating, and that gives Uniparts a 4 out of 8 on our KYC rating. Let's bring on board Ms. Tanushri Bagrodia, who's the Group Chief Operating Officer, Uniparts India, joining us. Very good having you, ma'am. Let me first start off by understanding from you that what's the outlook like? How quickly can demand revival happen? And how complex is the geopolitical and tariff environment currently for you to really pencil in certainty with regard to that demand revival?
Hi Harsh, hi Puneet, glad to be
Hi,
here.
good morning.
And good morning to all your viewers. I think, we are partners to global OEMs across construction and agricultural equipment industry. And so we are a part of this ever-evolving landscape, and the industry is really coming off a major transformation, perhaps one of the most major transformations that the industry has seen in many decades, actually. And different parts of the industry, different geographies are seeing green shoots in different forms and shapes. If you, and you spoke about it, but if you really look at our Q4 results, Q4 FY25, the revenue grew 21% quarter on quarter, which actually signals that the bottom is out and over, right? We anticipate that it is really the second half of FY26 where there will be momentum in this growth. And we've said the same thing on our earnings call. You spoke about geopolitical situations, you spoke about tariffs. So if I was to give you a little more color, region by region and industry by industry, North America remains the most impacted region. It was the most impacted across construction, large ag and small ag in FY25. Going forward, we see large ag in North America remain under pressure because commodity prices are volatile, interest rates are on the higher side, input costs remain higher, right? So this segment is going to remain under pressure and maybe have a high double-digit degrowth. Having said that, the European large ag market is looking much better than the American large ag market. Large ag doesn't exist in Asia Pacific. Now, in this market, we have been saying and we've been working very hard to deepen our penetration and our relationship with customers. And here we've won a very strong new business in Europe and some business in US as well. So we believe we will be able to outperform the large ag industry globally. Then, when you come to the small ag business, again, the small ag business saw tough times in FY25. India, actually, which is the largest producer of small agricultural equipment, was flat, but the US was down, Europe was down. Going forward, what we are seeing is that Europe is going to see, let's say, -5 to -10% sort of growth in FY26. But the rest of the world is going to be flattish, right? Now, this is a segment we are very, very strong in. We've won new business. So again, we will outperform the industry. Then comes the next segment, which is the construction equipment segment. Again, this is a segment that saw degrowth globally in FY25. But again, in FY26, what we are seeing is North America markets will be flat to minus
Right.
5% down.
Right.
The rest of the world is going to be flat. We've won new business, so we will outperform. I
Right.
think one of the key differentiators for us has been our aftermarket business.
Sure.
From FY20, and remember that the aftermarket that we supply to is
Sure.
very, very organized, right? These are all
Right.
retail stores that cater to the end users.
Right.
In the US, we've been able to grow significantly with the second largest retail store. In Europe, we are expanding our footprint. Globally, we are expanding our footprint. And when you have sorry, go ahead.
Right. Yeah. So completely point taken. Where should therefore the top line lie? You've guided for mid-teens. Is there a positive bias versus what you were seeing at the end of Q4 to what you've said in Q4?
So I think as of today, Harsh, we will still maintain that mid-teens growth because, we look at the order books of the customers. We are seeing where the customers are headed. And I think that gives us confidence along with the new business that we won that the mid-teens number is a solid number to stand by.
Ms. Tanushree, a very good, good afternoon to you. Thanks so much for joining in. In terms of, all auto components, there is a part of manufacturing as well that's currently happening. What's your current capacity utilization, and do you also, because there was somewhere I read that you have dual shoring manufacturing capacity both in India, US, and I think you have something coming up in Mexico as well. Essentially, does that mean that you have manufacturing in US and manufacturing is coming in for a particular client in Mexico in FY26 as well?
So, Puneet, if I could give you a little bit of color, right? See, I think we as a company operate on the philosophy of being the best cost supplier to our customers. This has been our bedrock since we started, right? We acquired the manufacturing facility in the US to be able to do dual shoring for our customers. We at the same time started warehousing solutions to do near shoring for our customers. And that is what we are expanding with, setting up a new warehouse in Mexico to be able to supply to our customers. We recently set up a new manufacturing facility in Ludhiana to do small and medium fab. You mentioned in the segment before I joined that, we have 6 manufacturing locations in India. And I think we have adequate capacity to grow. See, we're a discrete and batch manufacturing company, which means that as long as we keep doing balancing CapEx and we keep building on our capabilities, that is never a roadblock for us to service our customers.
Ma'am, apologies for this. How quickly does return ratios recover to 30% plus? Is that even possible? And how quickly does that happen? How quickly do margins recover 20% plus?
So you've seen that, our margins, our gross margins, one thing, Harsh, you need to look at is our gross margins have been stable year on year, right? And we've controlled costs, we've controlled our fixed costs. So as the top line grows, it's all going to be margin accretive. I think it's safe to say that in the midterm, we will go back to the 20% margins. And I think as we come to those 20% margins, the ROCEs will come closer to the 30%.
So is that FY27?
It would be, I think, I'd say it'll be a 2 to 3 year game.
Okay, so maybe FY28. So FY27, 28. Okay, thank you so much, ma'am, for joining us, giving us that perspective. Viewers completely out of time, frankly, on this edition of KYC. From Puneet, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit.